So today we are digging into a very detailed financial analysis. It's titled Revenue Up 84%, APLD Stock Deep Dive in 2026 Forecast. It's all about Applied Digital Corp's big pivot into AI infrastructure. And what I liked right off the bat is just how comprehensive it is. It flows really cleanly from the big strategy picture, through those Q1 results and then right into the risks.
It makes a really strong case for APLD's value, I think, especially with that $16 billion in potential contracted revenue.
Yeah, that foundation is laid out very clearly. You can see they've pre-sold their capacity. But, and this is the big but, the entire high-end forecast, that bullish target, it all hinges on one critical idea.
The market re-rating the stock.
Exactly. And I think we need to explore how to make that case absolutely airtight, because right now it feels more like an assertion than a quantified argument. That's a great point. That really is the unifying theme. If that $56 target is the goal, the logical path has to be rock solid. So let's start right there.
Okay. So the analysis needs to bolster the justification for the market re-rating of the stock from a minor multiple to a higher data center multiple by providing deeper contextual metrics.
I think the analysis correctly identifies this as the key catalyst. It asserts that APLG has, successfully transitioned from crypto-adjacent to pure-play AI infrastructure. But the problem is in the proof points. What's available today?
Right now. Yeah.
When you really look at the Q1 financials, a huge piece of that $64 million in revenue is very dependent on non-recurring items. The material itself points this out. $26.3 million came from that one-time tenant fit-out for CoreWeave.
Which is great cash flow, but it's not the high-margin recurring stuff the market wants to see.
Exactly. That lucrative monthly rent is still just layering in, so the whole logic relies on the promise of that recurring revenue without fully quantifying what it looks like today relative to its peers. The market is waiting for proof, and the current mix, well, it doesn't quite deliver that yet.
And that gap is precisely why the stock is still stuck with that lower multiple. So to change that perception, to make the case robust, the analysis has to explicitly connect the expected margins from that recurring rent once everything is fully online.
To industry benchmarks.
Yes, to the benchmarks for established data center operators. We need to actually build an analytical bridge from the old miner valuation to the new data center one. It's one thing to say margins will go up. It's another to show how much and how that compares to, say, an Equinix.
Okay, I see that. But isn't there a risk there? If you start modeling a hypothetical margin shift before they're fully operational, doesn't that open the analysis up to criticism that it's all just speculation?
That's a fair challenge, but this is a forward-looking analysis of a growth story. Projection is part of the game. It just has to be anchored methodically. So one option is to use their own operational milestones. You could look at that January earnings date and model a hypothetical gross margin profile based on that first 100 megawatts coming online. You're not just saying where it's going, you're mapping the trajectory.
The steps to get there.
Exactly. Or, another way, you could bring in a peer multiple, even one not in the main chart, and show what percentage of that multiple APLD should command right now, given its revenue mix and the execution risk. It shows the mechanism of the re-rating, linking operational success directly to the valuation.
I see. So it moves it from a qualitative observation, they're an AI company now, to quantitative proof, their margins are approaching X, so they deserve Y multiple. That definitely strengthens the argument.
It does. Now, if the re-rating is the goal, then we have to talk about the biggest obstacle the market sees: tenant concentration.
Right, I agree. The way that was handled felt like a missed opportunity. The two sections felt very separate.
They did. So the report introduces the customer concentration risk and the valuation gap as separate sections. But maximizing impact requires fusing these points to create a tighter logical structure around the derivative bet concept.
The argument as it stands is that APLD is basically seen as a derivative bet on CoreWeave, its biggest tenant. And that's a crucial relationship, especially when you see CoreWeave's rumored $80 billion plus valuation against APLD's, $8.7 billion estimate? But the analysis just lists customer concentration risk as a risk. It's totally disconnected from that valuation comparison.
And that disconnect takes all the teeth out of the argument.
It does. APLD is trading at around 20 times sales, while its main tenant has this massive premium. That gap is almost entirely explained by single-tenant risk, but the analysis doesn't force that connection.
That is the crux of it. The analysis is so focused on the growth that it kind of overlooks the systematic discount the market is applying because of that reliance. It would be so much stronger if it directly said, hey, APL's discount is inextricably linked to this customer concentration. We need to stop saying this is a risk and start saying this risk explains the valuation gap.
That's a really powerful reframe. It acknowledges the market's perception instead of just trying to argue against it. But how do you quantify a systematic discount? I mean, are you suggesting creating a dozen new metrics? That could get complicated.
No, not at all. It's about creating a framework. So, building on that, you could reframe the valuation gap section with a simple sensitivity analysis. Ask the question, what happens to APLD's valuation if we give the core weave risk a specific weighting? Maybe you propose a metric like tenant adjusted price to sales, something that discounts the revenue tied to that one big customer.
Interesting.
Or an even simpler way, just state that the bull case, the $56 target, assumes zero impairment from this risk. Then use the risk section to explain what happens to that target if the risk materializes. For instance, if CoreWeave's expansion slows down, the price target drops by X%. That turns a static observation into a dynamic part of the forecast. The risk actually informs the price target.
Which makes the risk section a real driver of the analysis, not just a disclaimer at the end. I like that. If CoreWeave is the value driver, its risks have to be central to the valuation. That's very actionable.
It is. So let's pivot to the final piece. The only way to mitigate all these financial and concentration risks is, well, flawless execution.
Right. The whole thing hinges on hitting those construction and energization deadlines. The analysis calls fiscal 2026 the inflection point for a reason.
Exactly. So the critical operational milestones provided in the 2026 forecast section must be further integrated with the execution risk to provide a more realistic and compelling outlook on that inflection point.
As it's written now, those milestones like the January Q2 confirmation or the mid-2026 Polaris Forge 2 ramp, they're presented almost like guaranteed dates on a calendar. The risk section does mention that construction or power delays can push timelines back, but it feels a bit soft.
It's way too soft for how important it is. These are huge capital projects.
We need to know what to watch before those dates to see if they're actually on track.
Exactly. The reader here is knowledgeable. They need actionable insight into how APLD is managing things like utility dependence and financing. The analysis should turn this risk factor into a key monitoring area. Because execution isn't just about building things, it's about deploying capital efficiently and managing those utility partnerships. The debt financing and the operational milestones are two sides of the same coin.
So what specific indicators should the analysis point the reader toward?
Well, let's look at the operational ramp section. You could add a paragraph on key indicators for managing this execution risk, things savvy investors should be tracking. For instance, what percentage of that $200 million credit facility from Macquarie has been drawn down? That number tells you the construction burn rate and gives you a real-time check on their capital management.
A leading indicator.
Precisely. And for Polaris Forge 2, the one for that rumored hyperscaler, you can specify what to watch beyond the official date. We should be tracking things like permit approvals or, even more critical, utility hookup confirmations from the providers in North Dakota. Power delivery is almost always the biggest bottleneck. If the analysis specifies those leading indicators, permits, utility updates, debt drawdowns, it allows the reader to front-run the official news.
That turns a static risk into a dynamic, measurable management challenge. You're not just reporting a forecast, you're providing a validation strategy for it. For a sophisticated reader, that's a massive improvement.
Exactly. The report becomes a living tool to help an investor stay ahead of the curve.
So we've really covered 3 big areas here to strengthen this analysis on APLD, all focused on making that revenue up 84% narrative more robust.
Right. First, we said the re-rating catalyst needs to be more analytically sound. You need to quantify that expected margin lift and compare it directly to peers to prove why the multiple expansion is warranted.
Second, we suggested fusing the customer concentration risk directly with the valuation gap. That way, the analysis explains exactly how the market's derivative bet thinking is creating that price discount.
And finally, we focused on sharpening that operational timeline. By integrating execution risk construction, power with project financing, you turn simple dates into complex challenges that the reader can actually monitor.